Investing isn't just about financial returns anymore, it's about making informed, responsible, and impactful decisions. Today, I represent a diversified investment portfolio that balances ESG principles, financial growth, and market risks. No stock is perfect, and it's nearly impossible to predict the future performance of any stocks with complete certainty. However, we can significantly reduce risks and increase our chances of selecting strong stocks by focusing on key factors. The goal is to align your investment choices with your financial goals and risk tolerance while ensuring the stock has strong growth potential. Key factors to focus on for picking the best stocks: strong fundamental financial health, valuation metrics, depth management, industry leadership and competitive advantage, management quality, growth potential, dividend sustainable if relevant, and risk and volatile metrics. As a young investor, I recognize the importance of taking calculated risks in order to maximize returns, especially given the long term horizon that my age allows. While equities inherently carry risks, my approach involves using financial knowledge to minimize these risks by selecting stocks that align with my both growth goals and my risk tolerance. In selecting stocks, I focused on small cap and lower mid cap companies, which are typically more volatile but offer great growth opportunity. To identify the best candidates, I applied a rigorous set of filters to ensure that each stocks met specific financial health and growth criteria. These criteria includes PE ratios less than 25, indicating the stock is not overly expensive relative to its earning. PB ratio less than 4, indicating the stock is not overvalued compared to its book value. ROE ratios, return to equity, greater than 10%, indicating efficiency use of shareholder equities. Debt to equity ratios less than 1.5, indicating manageable debt level. Interest coverage ratios greater than 2, indicating the company can easily cover its interest obligations. Current ratios greater than 1.5, indicating sufficient liquidity to cover short term obligations. Market capitalizations greater than 5,000 crore, and profit growth 5 years greater than 5%, indicating sustained growth. YOY quarterly sales growth greater than 10%, indicating increasing sales momentum. YOY quarterly profit growth greater than 10%, indicating increasing profitability. Profit Operating profit margin greater than 15%, indicating operational efficiency. Net profit margin greater than 10%, indicating strong profitability. By using these filters, I selected 5 stocks that fit with the lower mid cap and small cap range, while also demonstrating strong fundamentals. Each of these stocks align with my criteria and offer a good mixture of growth potential and financial stability. I have divided my portfolio into 3 categories based on risk tolerance. At 18, I am a unique position to take on more risk in my investment due to my young age and the long term horizon for growth. While I am aware that investing is an equities inherently carries risks, I believe that financial knowledge and the wealth research approach I can mitigate those risks and make informed decisions that will set up me for long term success. Given the nature of stock market, I have strategically chosen stocks that are considered high risk such as small cap and lower mid cap companies. Stocks are typically classified into large cap, mid cap and small cap categories based on their market capitalization. Large cap stocks are generally seen as less risky due to its stabilized market presence, while small cap stocks tend to be more volatile and riskier, often offering high growth potential. Mid cap stocks fall in between with moderate risk and growth potential. For my portfolio, I have intentionally chosen stocks with market caps between 5,000 crore to 25,000 crore, which fall into lower mid cap and small cap categories. These stocks offer a highly growth potential, but they also come with an increased level of risk. To manage this risk, I divided my portfolio into 3 categories: aggressive risk 40%, growth oriented risk 35%, conservative dividend paying stocks 25%. Stock in this category carry the highest risk but offer significant upside potential. As a young investor, I am willing to take on high risk in exchange for high returns. Growth oriented stocks. These stocks represent companies with strong growth potential over time. They may not provide immediately dividends but are expected to appreciate in value. Conservative dividend paying stocks 25%. Despite focusing on higher risk growth stocks, I have allocated a portion of my stocks to more stable dividend paying stocks. Five Star Business Finance is an example of an aggressive stock in my portfolio with growth potential despite its risk. Stocks like KNR Construction, Necto Pharma, and Share India Securities fit into growth oriented stocks category. They are part of industries expected to grow at a faster rate than the market, which align with my goal capital of appreciations over the long term. GMDC is an example of conservative dividend paying stocks, providing some stability to balance out the volatility in the rest of portfolio. Discussion standardizing ESG reportings. Lack of standardizing. Current ESG ratings from agencies like CRISIL, MSCI, and Sustainalytics differ significantly due to varying methodologies. This inconsistency complicates cross company comparisons. Call for standardizations. Government and regulates must stabilize common ESG metrics and reporting standards to enhance transparency, improve decision making, encourage companies to adopt informed sustainability practices.